Hey guys, welcome back to the ValueHunt podcast. And today I'm really happy to be here with Tristan. As you may see, I have my mic in my hand. So I guess this will be a pretty different episode with a pretty different guest. So let's see how it goes though. And I hope the sound is good enough for you guys. And yeah, I'm really happy to be here. Tristan is a really great investor which I was happy to meet on Twitter. We already did an episode back in 2024 with Andrew Brown. And yeah, if you want to check that out too, I guess it will be a good one as a follow up for this one. So yeah, Tristan, why don't you say a couple of words before we jump into the questions?
First of all, thank you for having me. It's a pleasure. Um, yeah, I suppose I'm happy for the opportunity and I'm open to taking any questions.
Nice, cool. So yeah, I guess my first question is actually what motivated you into getting to learn investing and all that, because I guess it's a pretty unusual hobby for an Australian kid or something. So yeah, guide us through that story.
Yeah, I suppose you hit a good point there because usually Australians would, it's very popular to be a property investor in Australia, but not so much into shares. And for me, I think part of the journey there was it was driven by my parents. My parents were more into, well, they did have an investment property. They were more into shares on a sort of a day-to-day basis. And that was driven by, I suppose, my father worked at BlueScope and BHP before BlueScope was spun out of BHP in 2000. He received some employee share scheme shares. It sort of directly saw the power of compounding over the years through those shares. He still has those shares. And yeah, I suppose over the years as well, I dabbled in blue chip stocks as well alongside him throughout the 2010s. That was before I really started investing by myself. That was more of a, I suppose I started part-time work and I would put my spare money towards blue chip stocks. I think over the years, sort of, it didn't really take off for me until I started studying at the university. As readers may know or watchers might know, I'm an accountant. I studied accounting and financial advice at university. And then probably wasn't until my last year in university where I started to actually start to invest. And then once I started full-time employment, that's when things really changed. Actually had some cash to do some investing with. And, as things started to grow in size, things also started to grow in and sort of how careful I was with that capital. Investing, it gradually got more and more process driven as opposed to more of a gamble or an intuition type of bet. But yeah, I suppose that's how I got into investing. Yeah.
Cool. And I guess you now have your own kind of partnership and all that. So it would be cool to know what made you took the leap between your professional accounting job. You also worked at KPG and all that to actually kind of launching your own trust, unit trust and all that. So yeah, probably that last part of the story would be really cool to understand better.
Okay, so going straight on from there, after I graduated university, I went straight into full-time gainful employment with a local accounting firm. And in that firm, what was common for accounting firms there was to provide financial services in addition to accounting. That was a way for them to grow organically. So I was essentially split between doing financial advice and accounting at the same time. So it would probably be like a 60-40 split. And I did 3 years in that firm doing exactly that. So I did a lot of wealth management with what was called self-managed super funds here in Australia and retirees. So I did a lot of retirement planning for retirees, and then as part of that process, you'd have to recommend portfolios, that type of thing. But usually that would be constrained to things like, ETFs, or in some cases, some local managed funds and stuff like that. But yeah, did 3 years of that. And then in early 20, or I should say late 2020, I decided to, well, I should say that I had been invested in Kelly Partners since 2019. And, over the year, I progressively learned more. I spoke to management several times. And I saw there was a job opening in my local town for a job at the local Kelly Partners office. So I decided to reach out to management, and I got them to get me an interview with the partners there. Lo and behold, the interview was a success. I got into that job, and I was there for 2 years. Learned the inner workings of how the partnership works in Kelly Partners. And then following that, at the tail end of 2022, the employment market was really hot. Wages were very good for, employees looking for work. Recruitment. I would often get recruitment firms reach out to me and try to poach me from the firm. This time I decided to talk to one. And pretty rapidly I went for 3 different interviews and got 3 different offers. So I was spoiled for choice and decided to take one and leave Kelly Partners. However, my experience there wasn't the best. So I was only there for 6 months. And then following that, I decided, I was a bit fed up of the, because I was at a crossroads really, where you either head towards management roles in accounting firms, which have a lot of client responsibility and a lot of team responsibility, but you don't see the work, you don't see the same remuneration. So it's all the responsibility, the same sort of pay. Was not a big fan of that. So I decided to just go out and start my own firm. And then alongside that, I also decided to, with the advice of some other people in Australia, decided to start a private trust. I suppose it's equivalent to a limited partnership in the US, but in Australia, it's called a unit trust. So the unit trust was started in May 2023, and I also I had to do some extra additional study before I also became a tax agent in November. Yeah.
Cool. Yeah, I guess that's a pretty unusual path. And one question I have for you as a follow-up is actually, what do you think about investing in a company and then actually trying to apply for a job there? Obviously, I don't know how your experience was with KPG, but I've thought about this quite a lot, because if you already like the company as an investment and you think it has long-term potential to grow and all that, I guess it would be already a starting point to choose a job or something. So I don't know if you totally agree with this, because you already have the experience. So yeah, please tell me your thoughts on this.
Yeah, well, I suppose you touched on it right at the end there. I already had experience, and the job was quite literally identical to what I was doing. So it wasn't hard for me to transition. But I guess what did help is that I had all of the prior knowledge about the business, and I knew I knew all of the words and the lingo that they wanted to hear in the interview. So the interview wasn't too hard. Just sort of spoke about Brett. But I suppose, in terms of I guess it's kind of decentralized, Kelly Partners. So at least in terms of the experience, investing in a stock versus working at the firm, it's not quite as like those two things. They are obviously synergistic, but just because of how decentralized it was, I wasn't next to Brett every day or anything like that. I was in a separate partnership with separate people every day. And I would only see Brett on the blue moon when he would decide to either come down or we would go for group-wide events. But, that's not to say I didn't learn a lot about the business. I learned about how the partnerships are managed, sort of how the partners interact with the central services team and just various other parts of the business as well.
Yeah, so I have a really hard question now. I hope you don't mind. But the question is, do you regret selling KPG?
Well, of course, the prices went up, so I'd be you'd fault me if I said no, right? But I suppose it was all process driven at the time. Like if you read my notes on Substack and stuff like that, I was a little concerned about how they would succeed expanding into the US. They've done better than I expected, but I expected it to take a little longer. And for that services team over there to, I suppose cost wise, it's kind of met my expectations, but I was uncertain about it. They started loaning against the parent balance sheet, which I didn't like. In the past, what they had done is they put debt within the partnerships, but they couldn't do that in the US. So they took a lot more, I suppose, credit risk expanding into the US. And the valuation at the time, I sold back in 2022, so that was my initial sale, and then I dabbled a little bit in 2023, but I wouldn't really call it anything major. So 2022, it was somewhere around $5 thereabouts. At the time, they were doing about, I think they had about 80 or 85 million run rate. Now they've got 130, 140 of revenue. So, the size of the business is a bit different. The valuation question is a bit different because it's a little less progressed. Not to say it's more than doubled in 2 years. So, to answer your question, I suppose. So, yeah.
Yeah. I think you answered it, and it was more like it was
loaded
meant
question.
to be like yeah, exactly. So yeah, but it's interesting to know, because I guess you're one of the most knowledgeable people out there on Kali Partners. So for the people that are invested in it, is quite interesting to understand why someone like you sold. So yeah, that was a pretty cool explanation. And now moving on to another question I have for you. I used to ask this question a lot to my guests in the early days, and I think it's a great question. Like I would like to understand what kind of adversities you had to go through to get where you are today. Obviously, probably a lot of unpleasant kind of jobs and all that, but yeah, just wanted to understand what for you was a big adversity that you kind of went through, and what you learned from that.
Not so much, to be honest. I mean, of course, I've had my fair share, but I'm not really a person that feels stress. At least I don't show it on my face, but my stress would kind of transform into physical stress, so I'd break out in hives and stuff like that. But yeah, I can't name. Obviously, COVID, the crisis there was supposedly, I guess that was my first real, if you want to say, recession. But that was quick. That was quickly gone. So it wasn't really much of a bad time for me. And I was working in accounting, which was an essential service here in Australia. So there was no change in employment. If anything, I think it was good for me because I got some government surplus, government handouts. So, the work remained the same for me, and I just did more work from home, which it suits me because I actually like working from home as opposed to in the office. But that's a whole can of worms in its own right. So yeah, at least in terms of adversity, I mean, over the years, employment in accounting is extremely stable. So I never had too much problems there. But in the last sort of 18 months, obviously, I've had to build up my own business. So that has been a process. And, at times it would get stressful. And I think, I'm experiencing the most stress now as I've just launched a wholesale offering for investors. And that comes at a cost in its own right. And the cost there is sort of driving me some stress as well. But, it's not something that I can't overcome. And I think the biggest thing for me is just remaining rational. Getting through adversity just takes sort of working through things, and basically that's answers your question.
Yeah, thank you for the honest question. Usually, people come up with some story about their mom or something just to make up something. uh, but yeah, to the point of rationality, I actually have a question on that. Like, how do you stay rational when the decisions you're making kind of weight on you psychologically? Because I guess there are some decisions that are harder to make than others, even though they are in the same kind of field. So yeah, what is your set of rules or tricks that you have in place to kind of make sure that you stay rational?
Well, I would say the biggest thing for me is to write things down. Writing things down helps you just, I suppose, work through ideas and get things. You can actually look at, externally express your feelings and then read it after the fact, and that sort of puts things into context. I think that's the biggest thing for dealing with, I suppose, the stress of making decisions. But yeah, I like I said, I can't really stress enough that I don't get stressed. So making decisions has never really been an issue for me psychologically. It's really just been sort of going through the motions. I'm not saying I'm not wrong. I'm always wrong, but just in terms of my emotional discipline, it's, I would say, pretty stable.
Yeah, that's pretty cool, and I guess that's something that at least people that do well in investing have in common, because there are way too many people. I'm not blaming anyone.
Like I rarely get FOMO and stuff like that. So like I don't think anyone's ever seen me talk about things like Bitcoin and AI on Twitter or anything like that. But I just completely avoid it, and I'm very happy about it. So yeah, that's fine.
Nice, cool. Yeah, I guess closing like these more kind of general questions I had for you. Let's go into more of the nitty gritty of your investment strategy and all that. So, I would like to understand, how does your approach kind of differ from the general common sense about investing, or like the typical Warren Buffett type approach? Or yeah, just tell us, how is it unique, and like how do you go about things in investing?
Okay. I think, my strategy, I think what's often overlooked from Warren Buffett is the concept of a circle of competence. I think people don't really take that literally, whereas I kind of have. And you'll see in my investments, if you ever like read my material and stuff, that it's pretty much contained to 5 different disciplines. And those disciplines are accounting, wealth, law, consulting, and finance. And that's, I used to just say professional financial services, but I've kind of recently created 5 different buckets, and I think those are the 5 buckets that I am actually like focused on a recurring basis. And I would, more than half of those investments would just be in the accounting discipline. So Most of my effort is in that area. So, I suppose it's definitely eating my own cooking, so to say. But that I've taken that concept very literally, and I think that gets me a lot of the way to getting a good hit rate on my investments. That's the whole point behind it, I suppose. Like I'm not going to sit there and pretend I know things about mining companies or biotech and stuff like that. But even simplistic companies that other people might consider investing in, I find that if I can understand them well, then everyone should be able to understand them well. So I prefer to have that edge. So yeah, I suppose that's one thing I take literally, and then other things I would say that I'm generally of the same. I'm looking for the same things. So I'm looking for a good business with good high returns on capital or improving returns on capital, and reasons why maybe catalysts or good management, a good valuation. And the way I go about valuations is very sort of, it's normal. It's normal. There's nothing groundbreaking about what I do there. But I suppose the main thing for me is that circle of competence. That's my real differentiation. Yeah.
And do you feel like you ever run out of ideas? Because, I mean, there are a lot of companies in those buckets, but probably your universe is a bit more restrained than other people that might look at everything, right?
Yeah. So I suppose for me that, up until recently, I was tracking about sort of 200 to 250 to 300 different companies. And by tracking, I mean, I've just got them all on the list. I'm getting news flow. And the news flow would determine what I would be interested in at any point in time. So I'm sure you might have heard of other investors. They just sit there and read announcements. That was literally what I was doing. So getting those announcements, you read things and you get picked up. You get tips on different stocks. So like things would come up, maybe a change of management, a change of strategy. Maybe they do a divestment, corporate action of some kind. There's any number of reasons why something can be interesting at any point in time. But what I did recently was the news flow was too much for me to be intimately knowledgeable about each of those businesses. So what I decided to do was cut that list back to the best 100. And it's still a work in progress. Like I'm always iterating on how I go about things, but for me, so far it's been good because I can learn more about each business. And I would say that, just because a business isn't cheap now, it doesn't mean it wasn't once cheap. So, things go in and out of favor essentially. So, if I'm well on top of, say, 100 different businesses, then one of them is destined to go into become a good situation in the future. So that's essentially how I'm doing things these days. Yeah. And the way, I suppose the other thing I actually went through and just played around with the numbers, right? I'd take a sample set and I'd say, how many of these companies in these industries outperform, say, 25% per annum over a 5-year period, any 5-year period. And it was like roughly 1 in 7 was the number I landed on. And I'd suppose depending on the day that you ask, the market environment and that type of stuff, that can change. But roughly I'm operating on the basis of 1 in 7 investments can sort of outperform my hurdle rate, so to speak, which is 25%. So what I thought to myself is, okay, I need to have 7 times what's in my portfolio, basically, at a bare minimum, because I'm not going to say that my portfolio is going to have 100% hit rate. But at a bare minimum, I need to be looking at 7 times what's in my portfolio. And I guess that's kind of how I landed on that 100 figure. Like I rounded it down a little bit, but that was the bare minimum number of companies I needed to track and have a reasonable expectation that I could actually pick winners. Yeah.
Cool. And actually, I'm a bit more kind kind of interested in that part of actually tracking the companies, because as you start looking at more and more companies, as you said, like it can get overwhelming pretty quickly, because
Mm.
everything looks interesting, everything looks like really good and all that when you have more time to look at companies. So how do you keep that news flow relevant and kind of sift through the signal, like the noise, and actually get the signal? So what tools do you have in place, and like how do you, what's your system for tracking those companies?
Yeah, so for me, I suppose the big thing is that I've set up email alerts for every different company, and those email alerts would just come to my every time a company makes an announcement, it would go to my email, and I would just read the email. And I'm in the process of working through those 100 companies at the moment, but those I want to have basically a working thesis for each one, and then the news flow can, it can either be sensitive or non-sensitive to that thesis, in which case I'll change things and change, maybe I'll change like, maybe now the price is interesting or something like that. But it's a work in progress. But for me, the biggest thing is to have those email alerts set up so I'm actually aware of the news flow of each of the 100 companies. But I'm also a subscriber to Koifin.
Oh,
It's I think it's pretty good. I think it's. I had used Ticker in the past, but I think there's a little bit of limitations with Ticker, just namely around sort of the. I suppose it kind of has everything, but it's like the watch list functionality in particular in Koifin is really good. So I just think that's just my preference, but I'm sure other people have different ideas. I suppose to answer your question, it really is just being on top of things. And the way I did that is for email alerts.
yeah. So I'm very curious to know about your strategy around turnover, portfolio turnover, because once you are like really focused on valuation and hurdle rate and opportunity cost, I guess there's always something better out there that can replace something in your portfolio. So how do you generally go about turnover and in the portfolio level?
It's a good question because in 2024, I did have 100% turnover. But in 2021, I had no turnover. So I have seen both sides of the coin. And I think since launching my unit trust in 2023, I have had higher turnover. I've just had the thinking that I couldn't be as nonchalant about my sizing as I was when I was managing my own portfolio. So getting things at the right size, and I also became more diversified. So just by virtue of that, making tweaks to the portfolio is easier to do essentially because of the sizing. Having the right position size, having a 5, 6 or 4% position is a lot more important than having a, sort of 30, 25 or 20% position. Like the movements there well, I probably said that the wrong way, but essentially, you know what I mean. The tweaks are easier to do and more frequent. And I think what my main part of turnover during 2024 was that I had quite a few rapid winners. So these are, and that's the hardest thing for me is like, do I hold on and wait for long-term capital gains discounts, or do I just sell and move into another position? Because I had no shortage of good ideas. I think that's what really sort of drove the turnover. Otherwise, I might just hold on to things. But because I have those ideas, I can sort of flip and continually improve the portfolio. But I think going forward, I want to reduce that a little bit. I increased my hurdle rates, and I also decreased the sort of price that I might revisit things at. So like I should say that like the sale price hurdle rate, if that makes any sense. So I'm giving things a little bit of a longer leash, and I'm also buying things at a lower price. So that was my adjustment to be able to try and hold things for a little bit longer, and I think it's worked well, at least on the investments that I have made recently. but it's not easy knowing when to sell things. So it's a constant process. Um, yeah,
Yeah, I feel you because currently I'm kind of looking at a lot of interesting ideas, and then you get the that kind of paradox or dilemma between giving it enough time to run and actually making sure your portfolio is optimized for the best kind of returns. So yeah, I think that's an interesting question that everyone has to think about for themselves. And actually, to the point of sizing, I would like to understand how you think about sizing positions. Obviously, I guess it changed from when you were investing your own money. And why do you felt that responsibility to kind of be slightly more diversified and all that? Because I guess you did pretty well with your with your strategy when you were just investing for yourself. So why did you make that change?
yeah. I suppose I'll start this question by saying what I was doing previously. And previously, what I would do is I would make equal weight size positions at cost, and that was out of savings. So I would save up a certain amount of money, buy a position, save up the same certain amount of money, buy another position, might be like 6 months apart. And I did that about 5 or 6 times. So I ended with 5 or 6 positions at equal sizing at cost. And it just so happens that one of those positions really, really ran on me, which is Kelly Partners. And I suppose that's a really good explainer of my results. One of them got acquired. That was pretty good premium. But other than that, I suppose the others weren't necessarily amazing outcomes. But that's I did that between the years of 2020 and 2023. So I had 3 years there where I was just essentially equal weight at cost, very concentrated, and that was just under my own money. So I kind of, I might be discrediting myself here, but it's kind of a fluke. But in 2023, I kind of, well, I suppose beforehand I was managing things more like a portfolio. But in 2023, I started the trust, and the reason, sorry, pen. The reason I diversified is because when I started the trust, there was outside capital that came in. And then the way the trust works is that when people bring money in or bring money out, I have to either mint new units or delete old units, if that makes sense. So there's always this units on issue component, and people can withdraw money. So the reason why I diversified is because I wanted my results to be more stable, essentially, because then, yeah, I'm fine with drawdowns, but not other people aren't necessarily fine with drawdowns. So I basically didn't want to give people the reason to withdraw, and I think that's very important for fund managers. So I suppose stabilize the sequence of returns, but also having a more diversified portfolio when there is need for making like changes to a portfolio or like selling and funding outflows, that type of stuff. But you have more options, so you can pick your positions that you want to sell. So it's just a lot more flexibility in terms of the tax as well. You can tap different positions. So I think there's a lot more flexibility there. But the other side of the coin, there is also there's more work. But because I went full time investing, I have more time. So it hasn't. I think I've landed on the right balance between how concentrated I am and how much work I can actually do. And for me, that's 20 positions, give or take 5. So, and then obviously, as I said before, I'm tracking about 100 on the watch list. So that includes the 20 I own. So about 80 other positions that I'm tracking as well. Yeah, if that answers your question, yeah.
Yeah, that's a great answer, and I guess it's a pretty different kind of game when you deal with other people's money.
Mm.
I can't imagine what that would be like. So yeah, another question I've been delving or thinking about quite recently is actually what does it take to become a full-time private investor? Because it's not just actually kind of having the financial means to do it, because I guess you have to make ends meet, but also like the other aspects like personal and all that. So could you guide us through like some of the cool parts about being full-time and some of the bad parts that you wish you could, yeah, just change, or that people should be aware of?
Yeah, I suppose for me, there's a few different things I should touch on here. I should say that I didn't just start full time. I'm also a tax agent, so I am doing services outside of what I'm doing in the investing realm. But that sort of helps day to day. But I did accumulate a reasonably large amount of capital to be able to sort of have some comfort, sort of self insurance, so to speak. But um, and I still have very relevant skill set if I ever did want to get into the market. Again, like the recruitment market, which I hope never has to be the case, but
Yeah.
it's there. Um, I think for other people, the way I went about it is, I decided to manage money for other people. So I wouldn't necessarily say that I was a full-time private investor. It's more so like I decided to basically start a business in the investing space. So, yeah, I think that's the. Is there anything else about that part of the question that you might want me to touch on? Because I feel like my answer might be a little lacking.
No, just like kind of the I would say some of the things that people might underestimate, because like I guess that when you say, "Oh, I manage a fund," or "I'm like full-time investing," or
Yeah,
something like that, people say, "Oh, wow, that's pretty cool." Like, what do you think those people are kind of missing of the full picture? Like, just
I
making
think
sure that, yeah, you.
I think I think having that 24-hour stress is probably one thing. I think you could probably say that of any business essentially, but I guess it's really so the case when you're investing because you can always do more work. There's never any clock off. So that's one thing. But as well, I suppose I have a very modest, like sort of lifestyle. So, I don't really have a bloated or like a luxurious um, living cost base, if that makes sense. So, um, that definitely helps because I'm not generating performance fees every month, that type of stuff. Um, there will be times where I get good income, and there will be times where I get no income. So having that supplement from the tax services business as well definitely helps a lot in terms of keeping things stable and running. But yeah, obviously, I think that's definitely a cliche here, but you want to make sure you have enough money to do it. And if you're not in starting an investment business, that number will also be different, completely different for other people as well. Like they might have more of a more responsibility, a higher cost base, more living costs. It's just a completely subjective question. So I know people that have started when they had only like $400,000 or $500,000. So um, you know, other people might look at that and be like, I spend that in 3 years. So um, you know,
Yeah,
it's contextual. Yeah.
I guess you're right. Also, you touch on the point of like lifestyle and all that. So I'm curious to know kind of how do you spend your time in general? Like, how much time do you allocate to investing, and like how do you structure your days, knowing that you have pretty much full flexibility on how to do it. So yeah.
Yeah, I think that was the appealing thing for me. I was really, really growing tired of the old, I suppose, the day to day of working in accounting. I would have to go to the firm, and then just sort of so basically take orders from someone else. And I'm growing progressively more and more tired of that, especially when you get into a management role, because I'm taking orders from someone, and then we worked with an outsourcing team, and that is a terrible experience. I would not recommend that to anybody. Basically calling up people in India and talking to them and giving them orders. So I'm this middleman and then I'm reviewing things that come back to me, and then they go back to the partner. So I'm like this middleman. Yeah, and that was very, that was not a big fan of that. So, don't have to do it anymore, but, my day to day now is definitely a lot more, I don't get paid by the hour. So I'm getting paid to make good decisions. So, I structure my days around sort of being able to take in information and, process the information, so to speak. So I don't like to, and I try to keep things as stress-free as possible. I've recently got into golf, for example, and that's been a great outlet. Like I'll just go, maybe in the middle of the day, maybe three or 4 days a week, 2 or 3 days a week, that type of thing. And I'll just go play a round of golf. And that is a massive memory reset. It just clears the mind. It's great. It's great for, de-stress. So, sort of, because I think for anyone that's played golf, they'll probably appreciate that, there's so many mechanics that go into like swinging the club right and hitting the ball right. It just completely wipes the mind. So that's been a good outlet. And then in terms of actual what I'm doing for investing, it's literally, it's just digesting information and deciding which information is material enough to make decisions on. I think
Yeah, by the way,
it's probably what people are thinking I'm doing. So, yeah.
yeah, okay. Yeah, I think that's not too much surprise, but I was just like going through your tweets before, and you reposted something on books. I think someone said like books are worthless or something like that. They're so expensive. So could could you tell us why did you repost that? Do you actually feel that way, or yeah,
I
probably
mean,
because
I've
I
got some
yeah.
books up here. I mean, the two I've been reading is, um, the investment checklist. I always go back to this book. I think it's great. But, Dear Shareholder, I'm sure people might know that book. I've been trying to write better letters, so I decided to read that book. I'm not going to say, like, I'm not definitely not as anti books as that person was, but I've got my fair share of books there. So I'm a fan of books, but I did repost it, and I did put in quotes, I said book summaries. And I think book summaries are a good intermediary between sort of sitting there and reading a book for 6 or 7 hours and getting the main points out of a book. So there's the one I posted was so brief, and it's completely free, and they just post like 10-minute book summaries. I mean, it's kind of similar to like Blinkist. If you ever seen Blinkist, that's that type of stuff. But I think I've read a lot of books in my early days, and these days not so much. But I mostly use them as reference guides these days. Like I was reading this Dear Shareholder book to be able to see like what kind of takeaways can I have from this book to be able to put in my own letters, that type of stuff. And then the investment checklist, I like to go back and look at the checklist essentially. So there's nothing really too crazy about that. But I think for me, I'm not going to sit there and read a book from A to Z. Mostly I like to pick up books to get ideas. So, I don't really care about the narrative behind the book or anything like that. But they're all non-fiction books as well. Like I have the ones down the bottom, I think, if I can get my hand there, you can see the red books at the bottom. That's actually Berserk. I don't know if anyone knows about Berserk, but love that. I've got all the books, deluxe volumes there. They're fiction books as well. So.
Yeah, actually, I don't know. I think Jeff Bezos said that he got the most ideas out of fiction. I still have to to kind of get my way around it, but yeah, I have to give it a shot, I guess. Um, also, like, just to kind of finish our wonderful conversation, I would like to ask you, what's the ultimate goal with your unit trust? Like, I'm pretty. I think. Sorry. Yeah,
That's
I
okay.
think your message is pretty clear. So basically, hurdle rate is your main focus. But other than that, do you have like a specific goal for the future? Like, where would you like to see your partnership, like in 10 years, 20 years time?
Yeah, I think up until recently, I saw it as a timed business. So I was actively telling unit holders that, look, I expect after like sort of 15 years that I'll probably wind up the trust and I'll have a great track record and everyone will be rich, and it'll basically be like a Joel Greenblatt type of thing or Nick Sleep, where you get this massive track record over like a decade or two, and then you sort of ride off into the wind. Peter Lynch, another one. So that was my initial idea, and that was before I started. I recently contracted a local a fund. I suppose you just call them a fund incubator, and yeah, to be able to provide financial services in Australia, you need to have a financial services license. I didn't have one up until recently, so I appointed this service provider. They have a license. Everything is legal these days, so I can start taking on capital from not only domestic but also international investors as well. So that has been a process in its own right. We'll see how it goes over time. Hopefully, it takes off, that type of stuff. But that also sort of, along with that, I started thinking about the business more in terms of maybe this will go a bit longer than I expected initially, but I in terms of like multi-decade time horizon, like strategy type thing, I'm still like sort of working on that. But at the very least, sort of, you would expect at least 10 years out of this. But I think in the contract that they've got sort of a 10-year expiry. So following that, we'll see what happens. But I just want to keep doing investing. So that's the main answer to your question. Yeah.
Cool. Yeah, I think that you picked some great role models in there, like that you want to model. So I wish you all the luck, and also I'm pretty confident that your skills will get you there. So that's pretty cool. So